Look, rates are going higher. Valuations are obviously up considerably from last year in the pandemic. And then I think you have overheated expectations. So you have this trifecta of three things that are working against tech short term. Obviously, we had a huge year. And I think expectations are out of check. I mean, we closely follow a lot of the private markets too. And if you would hear what's going on in the private markets, I mean, things are really hot and they haven't cooled off at all. And so I just think you go back to, we've got to digest what we went through last year in the run in tech. And expectations from a lot of our clients are just simply too high in some of these names and what they're able to do. I think we saw surge buying as it relates to the pandemic. And now you're digesting some of those purchases as well. So there's only so much cloud you can adopt, right? Everyone's going towards the cloud. But as you saw in Amazon's backlog numbers, right? The backlog numbers are great, but they're starting to decay a little. They're still really good. No one's going to complain about 50+% growth. But Brent, just the expectations of this continuing, I think, is a little overheated.
There's always some area in tech that doesn't get as much love as it deserves, no matter how hot the market is. So what is that here? Is it some of the old tech players that maybe have more good technology, more steady customer attention than the market is paying attention to, or something else?
Yeah, so my partner, Jared Weisfeld, who runs our tech desk, has been very excited about semis on the sell-off, the relative pullback. That's one area that Jefferies is pointing to buy on this pullback. I think secondarily, companies in my coverage like Intuit, you have a defensive business with tax, you have an offensive business with small business. We really like that story. Microsoft, right? Double-digit growth, incredible product cycles with Azure, with what's happening with Teams. So that's still a steady story. Amazon, what's happening in their business. So I think some of the larger cap names look a little more attractive on valuation.
Some of the names that you just mentioned have about, you mentioned defensive and offensive balance. They've got a few different businesses to call on. We saw that with Apple in this latest quarter where, services really performed well. The iPad and the Mac performed well. You mentioned Intuit, which has leaned into consumer recently. If we're heading toward a more volatile patch, is there a certain sort of diversification within these tech businesses that investors should pay attention to?
Yeah, we think the opening trades are really interesting. So we've called out three areas: travel with Booking and Airbnb, with dating, Bumble and Match. And then when you look at rideshare, right, Lyft and Uber, we think ultimately the demand for these companies in the back half of the year are really, really good. So we may see the stay-at-home names like a Netflix, even to some degree, the commerce businesses have a little bit of a decay as people go back out. But we think ultimately a lot of these businesses that were hit are going to see that in the back half of the year. You're seeing it in all the ad names. Snap, Twitter, Facebook are doing phenomenal. Twitter wasn't as good as the others, but you're seeing a surge in ad spend, and we think that's helping as well, those stories. So look, I don't think the party's over in tech. I just think that we need a realistic expectation check, given the magnitude of the move and given the magnitude of the multiple expansion that we saw in the last year.
Shepard Smith here. Thanks for watching CNBC on YouTube.